Welcome back to APPL-i Insights. In this three-part series, which we are calling Cut to the Case, we help viewers gain a basic understanding of how case studies work. In our previous episode, we discussed the basics of a business, like consumers and products, and looked at a market entry case. In today's episode, we will move to a slightly more advanced topic of profitability cases. This is episode 2, and we will be covering the basic concept of profitability, small guesstimations, and an introduction to basic accounting terms.
Good evening, Samriddhi. So I think before we jump onto our actual case, we could do a small exercise in the market for market sizing. Sounds good?
Yeah, sure, sir.
Okay. So our client is in the home appliances section. And to get into this theme, I was thinking if you had any ideas about the market and market size of a product like, let's say, washing machine.
So here it is, the dreaded guesstimate. Guesstimates are questions which ask you to reach a number for market size or even the profit margins for any good or service. So it could be questions like the number of petrol pumps in the country or even the number of calories consumed in a year. But it is not that bad. All you need to do is break down the question into parts and then sum them all up from the base. So the first step to think about is who all uses the product and come up with our own unit of analysis. The next step is to estimate the usage of the commodity in our unit of analysis. And then comes the final step, which is to aggregate all this consumption and to get the final answer. So for example, if we were to ask the number of chocolates sold in a day in India. So first up, we would ask what kind of chocolates? Dark chocolate, milk chocolate, white chocolate, with or without nuts, and so on. There are a variety of them. So let's say the case is about medium-sized milk chocolates. Now we can take either supply or demand side situations. For this case, we will take the supply side situation. So think of where all we can buy these milk chocolates. Retail shops, online stores, and most of the chocolates would be found here. But there would be some homemade chocolates that you would find in some small chocolatiers. So let's say, for example, each urban city would have around 200 retail stores. Each store would sell around an average of 20 milk chocolates, and that is the average amount of chocolate an Indian consumes. And that is the estimate we would get from a retail store in a city. In rural areas, we can take 10 shops per village, and maybe we can say that there are 5 chocolates sold at an average at each retail store. And so by breaking the consumer base into its various segments and then summing up the averages, you can reach the estimated solution. You can try this problem on your own and then check the results given at the end of the video.
Okay, great. So when it comes to a washing machine, I think I would divide the entire market size into basically 4 consumer segments. So they would be houses, hostels, hotels, and replacements. So on a side note, I'm assuming this to be India, where laundromats aren't as common. So I'm not accounting for them separately, which I might have done if it was for a market, say, in the United States. So I'm assuming that every tier 2 and tier 3 city to have an average of around, say, 30,000 and 40,000 households respectively with washing machines. And additionally, we could say 15,000 more for hotels and maybe 10,000 extra for PG and hostels. Adding in replacement bias, which we could take to be around, say, 5,000. And then we could multiply these by average number of tier 2 and tier 3 cities. Finally, when I factor in for a few extra purchases, I get my figure to be around 60 lakh washing machines per year.
Okay, great. So now on to the actual case. A major retailer of household goods and machinery finds out that their profits are down in the washing machine section, where profitability is below the market benchmark. Our profits have declined by around 5%. How would you help the client increase their profitability?
So just a few clarifying questions first. The objective would be to regain or increase profitability in this particular segment. Or are there some other goals that the company has in mind?
No, just profitability in the washing machine section.
So have our competitors also seen a loss, or is this just a problem specific to our client?
So our competitors have dropped very slightly from an industry average of 28% in 2018 to 27% now in the washing machine segment. Our client on the other hand used to have profits of about 30%, which have also now dropped to around 26.5%.
Okay, so basically, our competitors have had a slight drop of around 1%, while the clients saw a decrease of 3%. Is that correct?
Yes.
Okay, so I gauge that we have to basically find two things. First, the general market profit drop, as well as the specific drop in the client's profit. So our client, what kind of retail do they have exactly? As in, do they sell all types of household appliances, and what markets do they operate in?
So they are basically a Home Depot of sorts and sell everything from washers to food processors, air cons, etc. They also have a separate section on furnishing, and they operate only in India.
I get it. So I would like to have a few seconds to just organize and gather my thoughts.
Yes.
Hello, welcome to the world of profit. Profitability cases need an understanding of different channels of business, different channels of revenue, the business model, and some basic finance. That is a little bit of a long list, but it's not as complex as it looks. Profit in any kind is basically revenue minus cost. Revenue is the total money you earn from consumers, and cost is the money that you spend making or procuring the item. A more formal definition of revenue is that revenue is the income generated from normal business operations and includes discounts and deductions for returned merchandise. It is the top line or gross income figure from which costs are subtracted to determine the net income. Revenue is simply the sales price into number of units sold. Moving on, defining profit. Profit describes the financial benefit realized when revenue generated from a business activity exceeds the expenses, costs, and taxes involved in sustaining the activity in question. Profit is nothing but total revenue minus total cost or total expenses. Moving on to defining cost. Cost, in general, companies can have two types of costs, either fixed costs or variable costs. A fixed cost is a cost that does not change with an increase or decrease in the amount of goods or services produced or sold. Fixed costs are expenses that have to be paid by a company independent of any specific business activities. Whereas a variable cost is a corporate expense that changes in proportion to the production output. Variable cost may increase or decrease depending on a company's production volume. They rise as production increases and fall as production decreases. Discussing profit in a little bit more detail, revenue can be broken down into two constituents like we earlier discussed, price and quantity. Now, from basic arithmetic, we should know that total revenue is price into quantity. And this has a major implication that to increase profit, we have to increase either price or quantity or both. So you can sell 10 products at rupees 100 each or 100 products at rupees 10 each. Depending on what path you choose, you would be picking a high cost, low volume method or a low cost, high volume method. Costs, on the other hand, can be broken down into fixed and variable cost, like we discussed. Fixed costs are things such as electricity cost for lighting, land rent, etc. They hardly change as even the number of products produced increases. On the other hand, variable costs are such as material cost or labor cost rise for each new unit of the product produced. Thus, the first step to understanding and solving profitability cases is to figure out if the problem lies in the cost side or the price side. Do we need to cut down on the operational costs or decrease the price? Or is the problem with the decreased volume due to some marketing problem? Once you get to the root of problem, solving it would be much easier.
Okay. So when it comes to this problem, I think my first aim would be to find out if this is a price problem or a cost problem. So I'd like to understand a few things, such as pricing. Has there been a recent change in prices or over the last 2-3 years, or have our costs increased?
So for the variable cost, most of it depends on the manufacturers themselves. However, due to labor being unorganized, labor prices have gone up by around 1%. As for the cost of goods sold, according to our research, we pay mostly the same amounts to the manufacturers as our competitors who sell the same brands in regards that our EBIT costs are the same. And we also sell brands as per the manufacturer's suggested MSP, so the prices are the same.
I see. Firstly, excuse me, as you mentioned, labor costs have increased by around 1%. So I believe that's the 1% drop in profitability, which all the players in the segment have faced. So now that we've accounted for the general drop in profitability of the market, we now have to account for the remaining 2.5% drop in our client's profit, which is the client specific portion of profit drop. And you also mentioned different brands and their MRPs. So in line with that, could I have some information on the product mix we are selling? I'd like to find out if we sell a more high-end mix or a more cost-effective mix and so on.
So we do have data for this. Here's an exhibit you can look at.
So we had a lot of technical terms thrown at us, and I guess we should start by defining what they all mean. So EBIT that you heard a lot is basically earnings before interest and tax, which is the company's net income before income and tax expenses are deducted from it. And it is one of the main source of data used to understand the performance of a company. So EBIT is calculated generally by taking revenue, deducting the cost of goods sold from that revenue and the inventory changes. And that's how we get the earnings before income and tax. So EBIT is used to analyze the performance of a company's core operations without the costs of the capital structure and tax expenses that are impacting the profit.
So from this exhibit, there are three major insights which I can draw. First is that we are selling the highest amount of GE despite it having a very low EBIT. Our competitors do not do that. Secondly, we do not sell any store brands, which usually have a high profit margin. And finally, due to such a high amount of GE brand being sold, we have lesser sales in other brands as compared to our rivals. So based on this, my initial suggestion would be to consider changing the product mix that we are selling currently.
So you would want to shift the product mix then? Okay, how would you go ahead with this?
Actually, first, I would like to ask if there is any particular reason that we sell so much of GE as compared to our primary rivals.
Very interesting. Actually, there is. The GE manufacturers have high quality products and they have been a supplier for our clients since a long time ago. They even give our clients a 4% discount rate as compared to our rivals. But due to a shift in our storage facilities and related operational constraints, the profit margin have dropped from around 15% in 2017 to 11% now.
So basically, as the margins have dropped by 3% overall for GE, which would be a 2.4% decrease overall in our profit out of the total 3% drop. So I believe now that our EBITs for the different brands are equal, the first step again would be to change the product mix. And I think we could look at shifting, say, 15% of the mix from GE and divide it with, 10 to Whirlpool and 5 to KitchenAid.
Okay, and how does that impact the client?
So what I would do for this is basically calculate it in monetary terms. And as the total sales was 5 CR, we can calculate, I think, the current and new profits. And so basically, we would multiply them as the EBIT margins and the percentages of the sales that we have. And I think the calculations would look something like this. And we would be able to gain out of changing the product mix. So I think that is one thing we should be looking at.
Okay, so that clears up the product mix part. You briefly touched upon the store brand. Going by the logic of your calculations, as a store brand has an even higher EBIT, we could increase profits further. Do you think our client should also have a store brand? It seems to have a high profitability. Just an initial reaction would be fine about the considerations in this decision.
So I think when it comes to having a store brand, the company needs to spend in research, design, and even marketing to finalize a profitable product. And so I believe that, yes, they do have an advantage of knowing consumer preferences and having a general understanding of consumer segments, which is invaluable. But the market seems to have major players, which could be hard to compete with, not to mention the low sale of the store brands as per current statistics. Thus, even with the high profit margin, it might not be the best decision for now, as the company is already struggling with, declining profits. So I would not suggest them to start with, spending in R&D or maybe related costs in developing a new store brand.
Very well. Could you summarize the case till now?
Yes, sir. So I think as we started off, the client had a 3.5% profit drop. 1% was because of an increase in labor charges, and it was felt all over the industry. The remaining 2.5% was because of operational constraints, which led to the end of a 4% discount rate with which we had with the supplier, which was of GE brand. And finally, this can be corrected in part by changing the product mix of the company.
Okay, so before we wrap this case up, I would like to slightly shift lanes here. Recently, we saw that one of our franchises reported an increase in material cost for their food processors and blender segment. How would you go about helping in this client in this profitability section? Okay, would you suggest profitability hike, or would you suggest a price hike? What are your initial thoughts?
So I think the first step would be to divide the material cost segments into which parts exactly have been more expensive and why. So do we have a breakdown of material costs?
Yes, we do. So they divide the materials into 4 parts, which are casing and plastics, steel parts, attachments and additions, and finally miscellaneous. The percentage of these as a cost have changed as follows. So 17% to 15%, 50 to 50, 25, 31, 8 to 4. So we know that attachments and addition costs are more. Excluding operational optimization, could you hypothesize why the costs have increased or any other possible costs?
At times, cases can be aimed just at testing your ability to break down the problems into its subparts. Questions which ask the candidate to hypothesize about causes of a problem require you to think of all the kinks and the parts in the business which could lead to that particular problem. So everyone has their own way of detecting the components of a problem, but we recommend an easy way of putting the products together from the very scratch. So basically, think of what all goes into the making of a product, from raw material to parts of labor to assembly, etc., etc., etc. That helps you not only to maximize the chances of covering all the relevant aspects, but also helping you structure your answer in a very good way. In this case, watch how the candidate breaks down the problem into its subparts.
Okay, so I think the very first aspect that pops up would be the two possible cases. A, we are buying more additions per food processor unit, and that's why we are paying more. Or second, we are paying more for each of the additions. So basically, the additions have become more expensive, and that's why we are paying more. So do we have any information about which of the two cases the problem is from?
We don't have that as of now. Could you think of any other possible reason?
Okay, so still keeping the two cases, I'll divide the possible reasons that I can think of. So first, if we are buying more additions per unit, then I can think of three main reasons why our prices have gone up. So first is, there is a new product mix. So the additions, so that's why the change in price of additions. Secondly is a newer, costlier product has been introduced. Or finally, that waste has increased, probably due to how we're handling our product or so on, other reasons. Now, coming to the second case is that we are paying more per additional part that we are buying. So that could be because first, we have new suppliers who ask for a higher price. Second, it could be, just because suppliers are asking for more money. I feel like now suppliers might ask for more money because either A, their costs have increased and they are passing on their costs to us. Second, our negotiations have worsened. So maybe, just like as you said with the GE, we had some previous negotiations which fell out or something similar. or finally because all our different suppliers have unionized, or they have come together and they now all quote a higher price together. So I feel these are the basic reasons which might have happened, which led to an increase in our prices. So
Okay, so great job there. So now assuming that suppliers have increased their cost and the client wants to import these parts from Vietnam or Thailand, what are the main considerations would you take into account?
okay, so our client is considering importing from a different country now. I feel like the main questions to answer would be first, is importing really cheaper considering all the tariffs that might come with it and all the operational costs? Because we might have to, set up a new supply chain and other things. So that they have a lot of hidden costs there. So is importing really cheaper? That's the first thing that comes into my mind. Second, we could have is, can we set up a good supply chain, or are there any logistical issues? For example, some countries have infrastructural problems and so on. So that's another thing we have to see, that if we are able to set up proper operations and supply chains within our budget. Then third would be, are there any specific geopolitical risks in the country? If our country and theirs have worsening diplomatic ties, which could hamper our operations and so on. And finally, fourth, which is an important aspect, would be, does the product meet our quality standards and our models? Like, are the products we're trying to import a good fit for our own brand, and do they have the same quality? Most importantly, I would think of better alternatives or domestic suppliers, which might be a better option for us. Specifically with the government's push for local, there is a huge possibility, that we could look for better domestic options. So these are the main considerations I would have.
Great job. Thank you.
Thank you so much.
Okay, so great job there. So now assuming that suppliers have increased their cost and the client wants to import these parts from Vietnam or Thailand, what are the main considerations would you take into account?
Okay, so our client is considering importing from a different country now. I feel like the main questions to answer would be first, is importing really cheaper considering all the tariffs that might come with it and all the operational costs? Because we might have to, set up a new supply chain and other things. So that they have a lot of hidden costs there. So is importing really cheaper? That's the first thing that comes into my mind. Second, we could have is, can we set up a good supply chain, or are there any logistical issues? For example, some countries have infrastructural problems and so on. So that's another thing we have to see, that if we are able to set up proper operations and supply chains within our budget. Then third would be, are there any specific geopolitical risks in the country? If our country and theirs have worsening diplomatic ties, which could hamper our operations and so on. And finally, fourth, which is an important aspect, would be, does the product meet our quality standards and our models? Like, are the products we're trying to import a good fit for our own brand, and do they have the same quality? Most importantly, I would think of better alternatives or domestic suppliers, which might be a better option for us. Specifically with the government's push for local, there is a huge possibility, that we could look for better domestic options. So these are the main considerations I would have.
Great job. Thank you.
Thank you so much.
In this episode, we covered the basic concept of profitability and how to split profit into two constituents, being revenue and cost. We looked at the sources of fallen profitability and whether the problem lies on the cost side or the price side, as well as potential solutions for the same. We also learned how to make small guesstimations. We started with a guesstimate to estimate the market size and usage of our commodities, covering household, hotels, and hostels. We also looked into the market of new purchases and that of replacements. Also, we got introduced to basic accounting terms, including profit, revenue, cost, types of cost, EBIT, COGS, and days sales of inventory. We hypothesized about different problems that can arise by looking at the various stakeholders while discussing the problem of increased material costs. An easy way to do so is to split the product into its constituents and put together the product from scratch. So basically, think of what all goes into the making of a product, from raw material to parts to labor, assembly, as well as manufacturing, and look at the potential reasons for the problem. One way of doing so is to make a table consisting of the potential reasons, as well as the various stakeholders. In the problem of increased material costs, we discussed that it can be caused due to chiefly two reasons: either more additions being made per unit or paying more cost per additional part. So, more additions per unit can be caused due to either having a new product mix, a new costlier product, or increase in wastage of the product. Whereas paying more additions per part can be caused either due to new suppliers asking for more money because their costs have increased, our negotiations have broken down, or the suppliers have unionized. Apart from that, we looked at the four main import considerations or questions that need to be kept in mind while discussing about whether we need to import products or should we go for domestic suppliers. We discussed the first question being, is importing really cheaper? The second question, can we set up a good supply chain or are there any logistical issues? The third question, are there any specific geopolitical risks involved in the country? The fourth one being that would the product meet our quality standards as well as our models? In the end, after discussing these four questions, we concluded that we should look for better alternatives amongst the domestic suppliers, along with a slight push from the government, and that is how we ended our case. Thank you.